Hi, everybody. This is David Gully from Bentley University. This is another monetary policy video for our Bentley University EC391 YouTube channel. And today's topic is, can President Trump fire Fed Chair Jerome Powell? And is that even a good idea? So the short answer is it is possible that he may be able to do so, President Trump. But in order for him to be sure to be able to do that, the law would likely need to be changed. And even if he was able to do this, accomplish this, firing Jerome Powell, it's probably not that good of an idea for reasons we'll talk about. So our agenda today is, how do you get on the Board of Governors to begin with, and how do you become the chair? Can Jerome Powell be fired? What's the law on that? And then why does it matter if he is fired or at risk of being firing? And then we'll conclude with talking about the benefits of central bank independence. So how do you get to be a member of the Board of Governors of the Federal Reserve? And so the way the process works is a person is nominated by the president, and then they're appointed with the advice and consent of the Senate. And in terms of the specifics, they go before the Senate Banking Committee. They'll grill them, ask them about how they see policy should be run, et cetera. And then the entire Senate votes on them. And typically these votes are very one-sided. 98-2 or 99-1 are pretty typical, but sometimes votes are closer. Then once the person gets appointed, they have a non-renewable 14-year term. That will be important here for us in just a minute. But it is pretty common, we should point out, that people on the Board of Governors don't serve their entire 14 years. Now, if this happens, somebody will be nominated to replace this person. They go through the process. Then they fill the remainder of the term, and this is important here, the remainder of the term that was vacated, and then they get their own full 14-year term. And so the best example here is Alan Greenspan, who served for well more than 14 years, but he filled the unexpired term of a previous member. So then how do you become Fed chair? Well, the Fed chair can be either brand new to the Board of Governors, or it could be, they could be an existing member already on the board. And the process is the same. The potential chair is nominated by the president with the advice and consent of the Senate. Again, they go through the testimony there. But here, the chair serves a 4-year term, and these can be renewed in the same reappointment process as described earlier. So now this brings us to, okay, well, can the president fire the chair of the Board of Governors? Well, so key thing here is, I am not a lawyer, but I pay attention to these kinds of issues. Now, when you look at the legislation, there's a number of pieces of legislation that govern how the Fed operates. Is one of the major intents of these pieces of legislation is that the Fed should run monetary policy without interference from the rest of the government. So, for example, we have the long and non-renewable term, so the 14-year term, that allows a member of the Board of Governors to outserve a presidential term, which is 4 years, Senate terms, which are 6 years, and of course, terms of the House of Representatives, those are 2 years. So they can outlast political opponents, for example. And then the non-renewability, that's also important, because the members of the board don't have any incentive to cozy up to the president or to Congress and run policy in a way that makes the politicians happy, because their terms cannot be renewed. In addition, and this is particularly important, the Fed is not subject to the appropriation process for standard federal agencies. In other words, they don't depend on the president and Congress to agree to, send them money so that they can operate. They generate their own revenue from their balance sheet. So they own treasury securities, they own mortgage-backed securities, and they make loans to financial institutions. And those assets generate income. Most of the time, the income is higher than the Fed's expenses, and so they generate an operating profit, which, by the way, gets turned back over to the U.S. Treasury. But key is they do not depend on appropriations. And then finally, district bank presidents. Remember, there are 12 districts in the Federal Reserve System in the United States. They're appointed by the board of directors for each district. And then there's a whole process within each district bank to do that. So these folks do not, at the present, go through even the process for the appointment of a member of the Board of Governors. Now, in terms of carrying on here, so the Federal Reserve Act, which is the original act that brought the Fed into existence, notes that yes, Board of Governor members can be canned, but only for cause. And so that, of course, brings up, well, what does for cause mean? And the act is vague on that, but the standard sort of interpretation of this is, they commit some kind of crime, they embezzle or something like this, or perhaps, moral turpitude, they're, not very upstanding people, they are involved in scandals and so forth. So are there precedents in terms of the president's ability to fire a member or chair of an independent government agency like the Federal Reserve? And so one of the most famous cases is Humphrey's Executor versus the United States. This is from 1935. And this is when Franklin Delano Roosevelt, FDR, wanted to fire the chair of the Federal Trade Commission to put in someone who was more aligned with his view of how the FTC should work. Well, didn't make any claim of any cause other than he wanted somebody new. And so this went all the way to Supreme Court, and the Supreme Court said, well, no, that the FDR could not fire the chair for policy reasons. It had to be, again, for cause. Now, think of it like this, however, so in terms of policy decisions, maybe the president can't fire Jerome Powell for those, but suppose the Fed makes mistakes, and of course they do. They made plenty of policy errors over time. Could Jerome Powell, or for that matter, the entire Board of Governors, could they be fired for doing a bad job in the eyes of the president? Well, things are not quite as clear here, but standard policy differences probably won't cut it. So Jerome Powell has, of course, not surprisingly, been asked whether he thinks he can be fired or not. And what's interesting is Jerome Powell is a very highly trained and experienced lawyer. And of course, he's discussed his situation and the situation on the board with lots of other lawyers as well. And his view, and he's been very clear about this, is that no, he can't be fired. So just from a very recent article in Reuters, Powell also issued a pointed reminder that the Fed operates independently of the White House, and its leadership cannot be dismissed at will here. And the independence is a matter of law, going back to the statutes that govern the operation of the Federal Reserve, for example. And this last sentence here is very interesting. Fed independence has broad political support across political parties here on both sides of the Hill. Jerome Powell, in fact, other members of the board tend to go out of their way to meet with and build relationships with members of Congress, both in the Senate and the House. And, that's good policymaking, but it's also good from a strategic political point of view, because he perhaps might have allies in Congress who would maybe resist the president's interest in firing Chair Powell. So how much would this matter? If the president was able to actually accomplish this? In one sense, it might matter a great deal in the sense that, well, okay, if the president can fire the chair, or any other member of the Board of Governors for that matter, maybe that reduces the Federal Reserve's independence. And that would be a really big deal. And we'll talk about why in a second here. But perhaps as a matter of how policy actually gets run, well, maybe not so much. So let's suppose, just for the sake of argument, that the president is successful, fires Chair Powell. In fact, he leaves the Board of Governors altogether. And then the president gets a preferred person to become chair of the Board of Governors. Well, the chair, being chair, of course, is certainly influential. That can't be denied. But there are a total of 7 members of the Board of Governors. And on the Open Market Committee, this is the committee that sets the federal funds rate, for example, there are 12 of these people, the 7 Board of Governors members and 5 district bank presidents. New York is a permanent one, and there's 4 rotating out of the rest of the districts. And so the chair here would be 1 vote, perhaps an influential vote, but still 1 vote. Now, of course, this begs the issue, could the rest of the Board of Governors, the other 6 people, could they be fired? Well, if Jerome Powell could be fired, then maybe it's the case that, yes, the whole rest of the Board of Governors could be fired as well. Though again, this has not yet been determined, of course. So here's a way to make things, I guess, a little bit more complicated. So think of the positions that Jerome Powell actually holds. So he's a member, as we said, of the Board of Governors. He is a chair of the board, and he is also chair of the Federal Open Market Committee. And historically, the chair of the FOMC has always been the chair also of the Board of Governors. So there's not a rule or a law that says that has to happen. So if he is fired overall from the board, clearly he loses being chair of the board and being chair of the Open Market Committee. Well, now suppose, though, it becomes possible that he is able to be fired as chair, but not from the board. So he remains on the board. Well, it's possible that he would, decide he would leave, but he could stay on. His term does not end until February 2032. Well, if he stays on as a member of the board, but not chair of the board, he could still be voted as the Open Market Committee chair, because this is determined by a vote of the Board of Governors and the district bank presidents. Okay, and so there's some murkiness there in terms of how this situation might evolve if it gets to this. And so in terms of the next scheduled vacancy, so there's a term that expires in January 2026. So at the very least, the president would have an opportunity to fill that position. And if more become vacant, then would have the ability to fill others as well. So are there alternatives to a very lengthy and expensive and, perhaps to the financial markets damaging court battle to firing the chair of the Fed? Well, one option would be, change the law. The Fed is not enshrined in the Constitution. The Fed is created by a series of laws. And so if those laws were changed in such a way, allowing the firing of the chair of the Fed, or for that matter, the entire Board of Governors, then it would be possible. Well, this probably would take a long time, because you'd have to have the bill passed by both the House and the Senate. And as I've noted, Jerome Powell has gone out of his way to, sort of make friends and form relationships with members of Congress, both parties and both the Senate and the House. Another option, his term as chair expires in February 2026. And perhaps knowing he won't be reappointed, he might also at that time choose to step down from the board. Though, as I noted, he could stay on if he wanted until February 2032. So if he does leave, though, then the president would have the option or the ability to fill 2 more Board of Governor positions. Now, he's already filled 2 in his first term. This is Michelle Bowman and then Chris Waller. Could also, as an interesting option, appoint a shadow Fed chair. And presumably, this would be the person that the president will want to nominate to succeed Jerome Powell. If he decides to go that route, simply let him serve out his term as chair. And so if that's the case, then perhaps this person, knowing that they would be, becoming chair, perhaps in 2026, they could, make statements and try to, undermine or sort of override, perhaps, the statements of the current chair, Jerome Powell, because financial markets will think, okay, this person is going to be chair, and so we really need to pay very close attention to what they have to say. And then finally, and this is kind of, a standard operating procedure among presidents of both parties for a very long period of time, is to use Jerome Powell, in fact, the Fed in general, as a scapegoat. So if things aren't going well, if inflation increases or the economy slows down or some combination of both, blame the Fed. Plenty of presidents have done that, throughout the history of the Fed's operations, going back all the way to the 1920s and the 19-teens. And so, what we can do here is we can, think about, does what the presidents say about Jerome Powell matters? In other words, is it possible for the president to influence the stance of monetary policy without actually trying to do, or put it this way, without actually being able to explicitly dictate the terms of policy? And so, of course, the president has made lots of statements and social media posts about Chair Powell, which I'll give you an example in a second. And so the thing here is that, well, if financial market participants, the people who make the buying and selling decisions, if they think the Fed is going to respond to this political pressure, what we might observe then is a reaction in the federal funds futures market. This is a market for contracts, and these contracts are effectively bets or wagers on where the federal funds rate will be at various points in the future. And you can watch the price changes of these futures contracts in response to, in real time, to tweets or social media posts or statements that the president makes about Jerome Powell. And so these contracts then can give us estimates of what financial market participants think the federal funds rate will be at various points in the future. And I've got a good visual here in just a second. And so then the question is, do these contracts, or in other words, the implied future value of the Fed funds rate, does this respond to tweets or to social media posts? And the short answer is interestingly, yes, they do. So here's a recent post that the president made, on Jerome Powell. Clearly, the president is not really, very happy. Refers to him as, Mr. Too Late, loser, etc. Contrasting the Fed's, no change approach so far with the fact that Europe, has lowered interest rates already 7 times. The European economy has been recently weaker than the U.S. and so probably requires a looser monetary policy, at least so far, relative to the U.S. And so the pressure then is to, have the Fed pursue an easier monetary policy to reduce the risk that the U.S. economy slows down in response to, for example, imposition of tariffs and the uncertainties surrounding the imposition of those tariffs. So this is from a very recent study. These authors looked at a number of tweets and social media posts from the president, and they were able to follow, again, in real time, how financial markets, specifically here, the federal funds futures markets, reacted to these social media posts. And so they do what's called an event study. And so they look at a number of these posts. And so the vertical dotted line right here, that's the time of the post, time 0. And then they follow post, for the next 20, 40, 60, and 80 minutes, what happens to prices of various federal funds futures contracts. And so they look at, if you look at the blue line here, those are contracts that have exposure to up to 4 open market committee meetings. And so these open market committee meetings happen roughly every 6 weeks. So this is looking at most 24 weeks into the future. And then here, the red line, exposure to at least 9 FOMC meetings. This is looking at up to a year in the future. And so then on the vertical axis here, this is basis points. And so these are, so 1 basis point is 1/100%. But still, even with the small value here, there is still a statistically significant decline in the expected value of the federal funds rate going forward, perhaps even up to roughly a year in the future. Now, these are not large changes, so I don't want to, to overstate this, but even still, it's important to note that financial market participants think the Fed may be at least a little bit responsive to political pressure from the president. And so why does independence matter? This will be our closing topic here. Independent central banks, in other words, central banks that can make decisions without being pushed by the rest of the government, generate substantially better inflation outcomes on average. Or reverse that, central banks that aren't independent see much higher rates of inflation on average than independent central bank. And the underlying reason for this is pretty straightforward. Politicians pretty much around the world are not famous for being long-term thinkers. And that's not a criticism, that's an observation. They think more or less to the next election cycle. And so they want a booming economy so that their constituents are happy, they have jobs and so forth, and so they get reelected. And a question here, and this is, I'm trying very hard not to be political, but it's hard sometimes when politics and economics and financial markets kind of interact, is think of all the uncertainty and the issues that have been surrounding tariff and tariff policy recently. We have tariffs, we have a pause in tariffs, we have an increase in tariffs, we have a decrease in tariffs, et cetera. That's promoting a great deal of uncertainty and instability in financial markets and perhaps the overall economy. And so do you want the people who are making those decisions to also be in charge of running monetary policy, right? So I'll leave people to decide that on their own here. But what's interesting is that in terms of how financial markets have reacted to the president's statements on Jerome Powell, what we've observed generally is lower equity prices, a lower US dollar, and higher treasury rates. So in other words, this implies kind of a riskier, slightly more unstable world here. And so then let me close up with a very interesting visual from a recent study on central bank independence and the link with inflation. And so a number of authors have constructed indexes of the degree to which a central bank is independent. So here on the vertical axis on the left, the authors have average degree of central bank independence, and they've scaled it 0 to 1. 0 means the central bank does exactly what the government tells it to. A 1 says the central bank does whatever it thinks is right and can completely ignore the rest of the government. So a higher value is more independence. And so they measured it several ways, and the details for us are not important. So the solid blue line and the dotted kind of purple line here, those are measures of independence. And so notice that across this is a sample of 45 central banks that cover most of the world's GDP. Notice that there was a very strong trend starting in the 80s and then really accelerating into the 90s in terms of a notably higher level of independence for many, many central banks. And then the closing point here is this. The green line, that's the average inflation rate in those same 45 countries. And so as central banks became more independent, the average inflation rate fell and fell dramatically. So notice the right scale over here, the average inflation rate it was pushed down dramatically. And just probably not coincidentally, notice that in the late 80s here, in the very early 90s, there was a spike in the average inflation rate, and that perhaps helped drive the increase in independence of the central banks, who were then more free to conduct policy and were very successful at pushing the average inflation down. And this is a very important contribution to central bank independence. So wrapping up here, it would probably be very difficult to fire Jerome Powell as Fed chair. He's made it clear he would not go down without a fight. His term ends, as we noted, in February of 2026, and he will almost surely not be nominated as chair and will probably leave, though it's certainly not a sure bet here, will likely leave the board. As we've noted here, maintaining the independence of the Fed is a really big deal to promote a credible, stable monetary policy. Across the world throughout history, it is generally worked out very poorly to let politicians run monetary policy. But we want to be clear here in that central banks screw up, and sometimes they screw up very dramatically and make not just moderate, small mistakes, but sometimes really big ones. But still, on average, we tend to observe much better outcomes if we have independent central banks. All right, everybody, thank you so much.